Investing in small companies will yield very high returns, often up to 8 to 12% return. This can be a great way to diversify your investment portfolio. But what about the risk? What's up everyone, my name is Joris, welcome back to my finance channel. Crowdfunding is getting more and more popular every day. Due to the expansion of social media, individuals and companies can target a greater audience to market their product or company and look for financing. Crowdfunding targets the masses and tries to find money to finance a certain project, a good business, or even a good cause. Via certain digital platforms, you can invest in several projects with limited starting capital. Some projects can be started with as little as 100 euros. Others require 500 euros or more. All in all, the starting capital is very limited, and that is why it's gaining in popularity. It is very easy to get into. Moreover, in most cases, all costs are paid for by the lender. So as an investor, you don't have to worry about any hidden fees or costs. On top of that, the return is often very good, with interest rates on your investments between 3 to 12%, and those are not uncommon. A great return, especially if you compare it with the 0.11% return on your savings accounts. In Belgium, crowdfunding projects started taking off in 2016, when the GIA IMO collected 500,000 euros for a real estate project in Brussels. The investments for individuals ranged from 2,000 euros to 25,000 euros. It was a loan for 2 years with a 9% return. From this moment on, more and more crowdfunding projects sprouted and more investment platforms were founded. As we can see today, there are 4 main types of crowdfunding. The first one being the donation crowdfunding. A donation is made without any form of trade-off. After your donation, you're not getting anything in return. This type of donation seems economically irrational, and from an investment point of view, it definitely is, since your money is gone and you don't get anything in return. But still, these types of donations are very common. People will be donating money to help others in need. There is no financial gain for the donator, but the feeling of being able to help can also be a great motivator. Some of the crowdfunding projects can be very useful. It can save the life of a person that cannot get any of the medication they need, for example. Others, however, are not that useful. Still, a lot of money is transferred via these channels, and the motivation to do so differs from person to person. Another type of crowdfunding is called the reward crowdfunding. In exchange for a payment, you will receive something tangible, something physical. An example here is that you would receive a CD copy after funding an artist, or receiving a small piece of art when funding an art gallery. Another non-financial example is to smash the like button for the YouTube algorithm to support me, and you will be getting nice videos in return afterwards. These first 2 types of investments are not really financially interesting, since there is no long-term goal for your money. Investing without return or getting just a physical token in exchange for your donation is only interesting if you want to support the cause personally and make it very personal as well. Of course, luckily there are also other types of investing, ones that will actually give you a certain financial return. You could, for example, invest directly in a company. When a company issues bonds, you can buy some of these bonds and you can receive a yearly return on your investment, and if all goes well, at the end of the lending period, you will receive your original investment back. Often, smaller companies use these types of crowdfunding since they can receive large amounts of money in a very short period of time, and they don't have to go through the whole process at the banks. They can get some starting capital from different sources and investors, and they don't have to rely on the banks. Often bank financing is a lot harder, so they reach out to the crowds and to the masses. And the last form of crowd investing is the sale of capital. In the previous example, the company would issue a bond or a loan to the public in order to pay it back over the few years. But in this case, the sale of capital case, actual shares of the company are being sold to new shareholders. So there is no loan that is being issued, but just shares of the company being sold, and those people become owners of, partly owners of the company. The loan option, however, is the most appealing to the investors. An annual return of 3 to 12% is very interesting for those who do not want to keep their money on their savings accounts. Also, according to Bolero, almost 70% of all crowdfunding projects are crowd-lending projects, so the bond option, the loan option. Bolero further points out that the average return on crowdfunding projects, on their platform at least, is 5.9%, and that the average investment horizon is 4 to 5 years. 5.9% on average is very nice, especially if you compare it to your savings account. But don't forget that here in Belgium we have to pay taxes on the received dividends. So we will have to pay 30% of that 5.9% yearly return, resulting in a net return of 4.13%. These withheld dividends cannot be reclaimed via your tax application. Tax application only accepts dividends from individual stock shares. But then again, the 4.13% net return is a lot better than your 0.11% on your savings account. It looks like the perfect investment. It's a pretty good return, it is very easily accessible, a very nice looking platform, and you get the feeling that you are helping your own economy, and you can invest starting with as little as 100 euros. So why shouldn't you invest all your money in these kinds of products? Well, first of all, risk and return are majorly important here, and there is plenty of risk involved. If you compare the returns on bonds issued by countries or governments, you are getting a negative return on your investment at this moment. If you then look at bonds of major worldwide companies, a return of 1 to 2% gross is common. And that's because government bonds are extremely safe and company bonds are rather safe. And all of these bonds are rated by companies like Moody's, Standard & Poor's and Fitch, and these ratings translate to their return on investment. A bond with a higher credit rating will have a lower risk and thus also a lower return. A Belgian ruling in July 2018 lowered the requirements for crowdfunding projects. Before this rule, you needed a prospectus if you wanted to collect over 300,000 euros. But now, or since 2018, this requirement has been pushed up to 5 million euros, making it a lot easier to start a project for small to medium companies. Since crowdfunding projects are often so small, under 5 million euros, they don't need any rating or any company studies before looking for financing. So the risk of the company defaulting is a lot higher since it's all unknown. And that's why the return on the bonds is also a lot higher. As always, investing is balancing your risk versus your return. More risk, more potential return. Since crowdfunding is still in its very early stages here in Belgium, we don't have any reliable sources about the default rates percentages. We don't know exactly how many companies fail to pay back their yearly return or even the ending capital. We don't know how many go bankrupt. This grey area is not really appealing to me as an investor. You're basically gambling on the continuation of a company and hoping that their future cash flow will be sufficient to cover all the loan payments and eventually the loan payback. I have some serious questions about these types of investing. I understand that the supply is there. There's a lot of companies that are in desperate need of money and they want to get it as soon as possible. On the other hand, I can also see a lot of demand. There's a lot of people that have saved up a lot of money on their savings accounts and they are looking for a better return. They also want to invest in something that is Belgian, something that they know, something that is theirs, and something that they saw on TV or in the streets. My first worry is the actual default rate percentages. Bolero points out a 3.23% default rate in 2020 and Look & Fin, another portal, shows a 1.52% rate. That doesn't seem too high, but that's only accounting for loans that are 100% sure to not be able to be paid back at the end. Loans that are currently being extended, or if they look for another solution, those are not in those calculations. What I often worry about is why these companies turn to the public for their financing in the first place. If they can't get a loan from the bank, it does show that their financial numbers are not that great. And the bank has a better understanding about their financial status than us investors. If the bank does not want to take the risk, then why should we? Would you only invest in crowdfunding because of the returns? The average return of 5.9% gross or 4.13% net? Well, is it really that high if you compare the risks to the return? And this brings me to the second question I have. Why would you invest in projects like these with such a high risk if you can simply invest in a worldwide tracker that has the same or even better returns? Of course, there's also risk involved in a tracker. It's a 100% equity tracker after all, but it invests in 1,500 or more companies. Companies that have proven themselves in the past, the biggest companies on the planet. So a return that is lower than a worldwide tracker is not really defendable for a small and local company without proven records of the previous years. On top of that, you are betting on one company instead of diversifying on more than 1,500 companies. The loans that are being issued are also subordinated bonds, which means that you as an investor will unlikely get your money back in case of the company's default. If this were to happen, the company will be liquidated and everything will be sold. And then, first of all, the suppliers and other creditors will be paid. And then, after that, if there is any money left, then you as a subordinate bondholder will be paid out. But in most cases, this won't happen. Another point you should look at is the liquidity of the product. If you were to buy a company or state bond, the liquidity of this bond or product allows you to resell it if you need the money. And in most cases, there will be a buyer for your bond. Although sometimes poor liquidity might lower the price of the bond. But still, the average bond will be sold at a good price at any time. Major banks and central banks often buy bonds. And so there's always a market in the most common bonds. But the same cannot be said about crowdfunding bonds. Here the supply and demand affects prices heavily. These bonds are not noted on the stock exchange, so their exposure is very limited. And if there are no buyers for the bond you want to sell, well, you might not even be able to sell it or have to sell it at a very, very bad price. At that point, it won't even be worth it to sell it. Banks won't buy your crowdfunded bond, and you have to find another individual that will buy it from you, which will probably be very rare. So basically, you will be stuck with a bond for the full duration of the bond. And even when the company starts to miss payments and there is really a financial problem, you won't be able to sell because everyone will be selling at that point and no one wants to buy. So investing in these bonds is really more of an all or nothing investment. For now, crowdfunding gives us a false feeling of safety. You can see high returns and you can start with a small capital. It's all nicely shown on big online investment portals. So you can assume that it won't hurt you financially and everything is pretty safe. But crowdfunding bonds are often considered subprime or even junk bonds, and their liquidity can be a real issue. So please don't consider your investment completely safe when you are investing in these specific products. I'm not saying crowdfunding is bad, but it does pose a certain risk you should be well aware of before investing in these products. Crowdfunding bonds can be a nice diversification tool in your investment portfolio. It's also a very cool way to invest in companies that are very near to you. So you're really helping your local economy. It's also a perfect way for some companies to get money they would never be able to get, and it allows the economy to grow and change over time. New companies that have not proven themselves in the market are able to grow. We're still in the very early stages of crowdfunding here in Belgium, so not a lot of research can be done about the default rates on these companies. Crowdfunding, however, is a lot bigger in the UK and in the USA, and we can see that the default rates there are quite acceptable as well. In those mature markets, the numbers are quite reliable. I trust that the crowdfunding market in Belgium will continue to grow over time. All in all, crowdfunding is a nice alternative way of investing, and it definitely has its place in a well-diversified portfolio. But please always be aware of all the risks involved and don't fall in love with the high projected interest rates. Always do your own research before investing and stand by our choices. Not every investment is perfect, and there are no real ideal investment strategies without any risk with good returns. So please diversify, diversify, diversify. If you have enjoyed this video, please leave a like for the YouTube algorithm, share it with a friend, and subscribe to the channel if you have not done it already. Also hit the notification bell so you will be alerted when the new video comes out. I thank you very much for watching, and I will see you in the next one.